Good evening, I'm Dusty Shimkus, and tonight I'll be providing a strategic analysis on Chevron Corporation that will cover their current operations and financial position, as well as provide a few recommendations that the company could implement going forward to better improve their competitive positioning. A brief history of Chevron is that the company was founded in 1879 as the Pacific Coast Oil Company, which was 3 years after oil was discovered in California. They would maintain this name and their independent status up until 1901, which is when they were acquired by John Rockefeller's Standard Oil Company. They would remain part of the Standard Oil Company from 1901 until 1911, which is when the Supreme Court used the Sherman Antitrust Act to break up Standard Oil into over 40 companies nationwide. Chevron was one of these companies, though at the time they maintained the name the Standard Oil Company of California, which is a name that they actually kept officially up until the 1980s, when they changed the name to Chevron legally, which Chevron was the name of one of their brands that they introduced in the 1930s. So the Chevron name brand had over 50 years of customer recognition when the company officially became Chevron in the 1980s. In the bottom right-hand corner, you also see the Texaco logo. So Chevron and Texaco is one of the 7 sisters that ruled the global oil market throughout much of the 20th century. So the 7 sisters were the oligarchy consisting of Chevron, Texaco, Exxon and Mobil, and a few other companies that were the big oil companies of the 20th century. And of the 7 sisters, Chevron and Texaco were known as the twin sisters because they often partnered with each other in often notorious and ruthless ways to elbow their way into the international and domestic oil market. They started off in the 1930s, which is when they entered a joint agreement to allow Chevron to access Texaco's Far East and Asian markets, which is a footprint they still maintain to this day. And in exchange, Texaco got to use Chevron's or Standard Oil Companies of California at the time upstream market, which is their exploration and drilling assets in Saudi Arabia, which is so Saudi Aramco, which is the Saudi oil company owned by the Crown Prince now, was part of Chevron for most of its history before it was sold off to the Saudi Arabian monarchy a couple of decades ago. But then in 2000, Chevron announced its intention to acquire and merge with Texaco, which was around the same time that Exxon and Mobil also merged. There's a period of mergers and acquisitions and turmoil in the global oil industry, and the company was actually named Chevron Texaco, just like Exxon Mobil is one name right now. It was Chevron Texaco up until about 2005 when they dropped the Texaco name and reverted back to just Chevron. So Chevron and Texaco's reputation as the twin sisters for their notorious and ruthless ways is really counter to the image that Chevron's painted for itself today. So they really focus, if you go to their website or read their annual reports or their press releases, they really kind of stress their commitment to diversity and inclusion and the protection of people and the environment. And you could say that, it's just the social pressures, the business environment that we operate today, where people expect companies to be ethical in their handling of their operations and also to look out for the environment, especially for an oil company, which we recognize the social and often political pressure that the global warming activism has put on these companies, especially in the financial world now too, with the rise of ESG, the environmental, social, and governments investing, which is now a $1 trillion industry in the finance market. So oil companies, like all companies, are under a lot of pressure to conform to the environmental and good stewards rule that corporations are held to today. So you could say that it's large because of that, but also Chevron's recent record for ethics violations is actually very strong. So you could say it's insincere, it's just a major oil company, a historic villain in the corporate world that they're just trying to pass it off while they do what they always do, but the record is actually very strong. Recent record is actually very strong in the ethics category. So the Chevron way covers this. This is Chevron's company culture that they push out as the Chevron way, which covers their ethics, but also covers their business model and strategy. So when you look at Chevron's strategy, or really the strategy of any oil company or major oil company, or the oil industry, I should say, it's always divided into 3 segments. You got your upstream, downstream, and midstream. Upstream refers to oil exploration and drilling. Those are the drill rigs you see in West Texas or the fracking operations in North Dakota or in the Gulf of Mexico. Downstream is a bottle of Valvoline you buy off the shelf at your local auto parts store or the gas station down the street that you fill up your car once a week at. The midstream is a refinery business and the transportation infrastructure and supply chains that links those drill rigs to the gas station down the street where you fill up your car. And the way that Chevron makes business is by, and this isn't too complicated, is that they sell oil for more than it takes to produce it, which for most oil companies is around $40 a barrel. Chevron, because of their economy of scale and because of their investment into technology, has lowered that price of break even into the $30 range or into the $30 range for their break even point for a barrel of oil. So they really push growth through their economy of size, getting access to those oil reserves, which are in the ground, whether it's in the ocean or in the Permian Basin in West Texas, which is currently their major target point. And then through more efficient execution, hiring better people that can push that strategy, and then really technology and functional excellence, which is really technological innovation in order to extract oil from the ground in a more efficient manner and in a more profitable way. So we'll see also that the oil, like the rest of the oil industry, Chevron's financials really ebb and flow with the price of oil, which is a commodity sold across the globe, marked by the crude barrel price or the West Texas WTI price that you may see on CNBC or any other financial website or news organization. So we'll see, like in 2017 and 2018, as the global oil prices rose, their operating profit margin also rose. In 2019, oil prices depressed, which also brought down their operating profit margin. But what I really want to focus on for Chevron, which really sets them apart from the other oil companies, is their debt statistics. So I've highlighted current ratio, total debt to assets, and debt to equity that highlights Chevron's relatively low debt. I say relatively because the oil industry is notorious for having very high debt ratios. Chevron has an industry-leading balance sheet because of its low debt. And they actually caught flack for this before COVID hit, because ExxonMobil, which is their biggest competitor, was taking on more debt and expanding rapidly into the upstream markets in order to increase their market share. While Chevron took a more conservative approach, kept debt low, which, as I said, they caught flack for when COVID hit and the economy tanked and the oil industry especially tanked, as we all saw oil prices drop to negative price per barrel in April. So the one-year forecast on the right hand of the screen, it's kind of everyone's guess or anybody's guess at this point. We all know that many companies have suspended guidance going forward. No one knows if there'll be more shutdowns, how the national economy or the global economy is going to respond to this moment that we're in. But given Chevron's strong balance sheet, they are positioned to come out stronger than any other oil company. And they've already kind of expressed this in their acquisition of Noble Energy, which was an upstream oil company that they acquired for $5 billion 2 weeks ago. So they've shown that they're willing to use their strong financial position to be an aggressive player in the oil industry, while the rest of the industry is struggling to keep their head above the water because of their high debt ratios. So 5-force analysis, a lot of people will be familiar with this chart. Not all of these circles are weighed equally when it comes to the oil industry. So new entrants is not a huge threat to Chevron, a $100 billion company. However, substitutes going forward is a major threat to the oil industry, but it's also often overstated how much of a threat it is. You see the rise of Tesla and electric vehicles and the push for wind and solar power in both social and political terms, and it seems that the death of the oil industry is near. However, Chevron and other analysts project the global oil demand to continue to increase until 2040, which is the opposite of what BP recently announced when they project that the global oil demand will decrease by up to 75% by 2030, which is why they're cutting oil output by 40% and really trying to pivot to green energy or renewable energy. BP's pivot provides a great opportunity and also challenge for Chevron. It's a great opportunity because if, as Chevron's analysts project, and as most analysts project, the global oil demand will continue to increase to 2040, then Chevron can be a net buyer, given a strong financial strength of BP's assets that's selling off. BP is planning to sell off over $25 billion of assets, mostly in its oil and natural gas segment, as it attempts to pivot towards green energy. Chevron can be a net buyer of BP sell-off to expand their presence both upstream and downstream, domestically and internationally. Domestically, they can expand their downstream operations, which is their retail gas stations presence, into the Midwest and Northeast. They're currently very concentrated on the West Coast and Gulf Coast, but they can expand back into the Midwest and Northeast to gain market share, and also into Europe, which is where BP's headquartered. But BP's pivot to green energy also poses a threat. So Chevron has a subsidiary called Chevron Technology Ventures, which is really kind of a hedge fund inside Chevron that invests into green energy companies or also just technology companies for the oil and gas industry. And right now they have over $100 million invested into different companies. However, even though the global oil demand will continue to increase until 2040, eventually the world will shift to cleaner, more renewable forms of fuel if current trends hold. And if BP is going to pivot that hard into the green energy and renewable energy space, then Chevron needs to keep up. And investing $100 million, while it sounds like a lot, as I mentioned earlier, Chevron's a $100 billion plus company. So $100 million isn't really that much. But you could take $1 billion and they can buy out some of the clean energy companies that they're currently investing in, which is like Natron Energy Company, which develops new battery power technology. So instead of starting from scratch and starting their own operations to become a clean energy company or to have an operational part of the business that's dedicated towards clean energy, they can simply buy out a company that they're already invested in, which means they're already vetted and believe in. They can buy them out, make that part of Chevron so that they continue to profit from the global increase in oil going forward for the next 2 decades, but then they're also positioned to transition their company to cleaner and renewable energy forms in the long-term plan for the company. Doing this, Chevron continue to be a major energy company, whether it's oil or renewable energy going forward, and they promise to be a continued force on the American corporate landscape for decades to come. My name is Jesse Shimkus, and thank you for listening to my presentation.